On June 25, Apple changed the price of a 512GB MacBook Air from $1,099 to $1,299. Same laptop, same storage, $200 more. The iPad Pro rose by another $200. Apple TV jumped from $129 to $199. There was no major new product launch attached to those increases. Apple pointed to rapidly rising memory and storage costs. And part of that pressure is coming from AI data centers competing for the same hardware used inside ordinary consumer devices. At the same time, Amazon, Microsoft, Google, and Meta are preparing to spend as much as $725 billion in a single year. Capital spending could consume 94% of their operating cash flow. But in a major survey of companies using AI, only 5% had reached the point where it was consistently creating value at scale. Record construction on one side, a customer base still trying to prove the return on the other. That gap is where the bubble question actually begins. This is not an argument that AI is fake. The technology works. Some companies are already making real money from it. Others are saving time, writing software faster, and automating work that used to take hours. The question is narrower. Will customers pay enough, soon enough, to justify the speed and price of everything being built? Because history has already shown us something uncomfortable. A technology can transform the world while destroying many of the people who financed it. In 2020, Amazon, Microsoft, Google, and Meta spent roughly $90 billion on capital expenditure. By 2023, that figure had risen to around $147 billion. In 2025, it reached approximately $410 billion. Their current 2026 plans add up to as much as $725 billion. Capital expenditure is money spent on assets expected to last for years. Data centers, chips, servers, networking equipment, cooling systems, and power infrastructure. This is not another software update. It is an industrial construction program. When you ask an AI model a question, your laptop does not perform most of the work. The request travels to a warehouse filled with specialized chips and memory. Those machines consume electricity. Electricity creates heat. The heat requires cooling. The building needs transformers, backup power, and high-speed connections. And the chips do not last forever. A new generation can make expensive equipment commercially outdated long before the building itself wears out. The product looks like a small chat box on your screen. Behind it sits an expanding network of factories for computing. PIMCO estimates that hyperscaler capital spending could absorb 94% of operating cash flow in both 2026 and 2027. The figure was 40% in 2023. Then 49, then 68, then 75. Now, the estimate is 94%. Operating cash flow is the cash generated by the normal business after everyday operating expenses have been paid. So this does not mean salaries receive only $6 out of every 100. Salaries have already been counted. It means nearly all the cash produced by the existing business may be sent back into equipment and construction. 94%. That is not a side project. That is a company-wide commitment to one view of the future.
Now, look at the businesses expected to fund this expansion. BCG studied more than 1,250 companies. 14% were classified as stagnating. Another 46% had started experimenting with AI, but were still struggling to scale it and produce material value. Together, that is 60% of companies receiving little or no meaningful financial return. 35% were beginning to scale successfully. Only 5% had reached the point where AI was consistently creating substantial value across the organization. That does not mean 95% of AI has failed. It means that using AI is much easier than turning AI into measurable profit. Imagine you run a customer support company. You install an AI assistant, and it genuinely helps employees answer questions faster. But now you are paying for the model, the integration work, security reviews, new software, and employees who must check unreliable answers. The tool works. Usage rises. The demonstration looks impressive. But when you add everything together, the financial saving is still small. That is the distance between an AI product that works and an AI deployment that earns money. The small group BCG calls future built performed much better. It recorded 1.7 times the revenue growth and 2.7 times the return on invested capital of less advanced companies. So the 5% is not evidence that AI has no value. It proves the opposite. AI can create substantial value. But right now, that value is concentrated among a small group of companies that know how to redesign workflows, measure results, and deploy the technology across the organization. The infrastructure boom assumes the rest of the market will eventually learn to operate more like that small group. That may happen. The factories are being built before anyone knows how quickly.
If the customer returns are still uncertain, why not build more slowly? Because waiting carries its own risk. Microsoft cannot risk Amazon controlling the next generation of cloud computing. Google cannot assume search will remain protected. Meta wants enough computing power for its own products. Amazon cannot allow AWS to fall behind. Every company is afraid of being the one that spends too little. And that creates a problem. Every company can make a rational decision to build more. The industry can still end up building too much. Think of one busy town with one successful hotel. A second hotel may also be profitable. But if 20 companies see the same opportunity and build at the same time, the town does not suddenly produce 20 times as many travelers. Each investor reacted to a real opportunity. Each built for future demand. Each assumed it would capture a large share of that demand. They cannot all capture the same customer. That is how a real opportunity becomes overcapacity. Economists call this the capital cycle. High returns attract investment. Investment creates more supply. Supply can eventually grow faster than demand. Prices fall. Returns collapse. Weak operators leave. The survivors buy useful assets at much lower prices. Nothing in that sequence requires the technology to be fake. In fact, the cycle usually begins because the opportunity is real. Investors see growth. Competitors rush in. Factories expand. Capacity arrives. And then the market discovers that a correct prediction about the future can still be paired with a terrible prediction about timing. The cost of the current race is already traveling through the supply chain. AI systems require enormous quantities of advanced memory. Suppliers naturally direct capacity and investment toward the products generating the highest returns. That can tighten parts of the consumer market. Device manufacturers then have three options: accept lower margins, reduce specifications, or raise prices. Apple eventually raised prices. The consumer is already seeing the cost of the build-out. The eventual return is still being tested. We have seen this economic mechanism before. In the late 1990s, telecom companies correctly predicted that internet traffic would explode. They were right. More people were going online, more businesses needed connectivity, more data would move across networks every year. So telecom companies borrowed money, sold shares, and rushed to install fiber optic networks across the country. Multiple companies laid competing fiber along many of the same routes, each expected to attract enough traffic to justify its own network. The prediction about the internet was correct. Their assumptions about timing and competition were not. Customers did not arrive quickly enough to support every builder. Capacity grew faster than demand. Internet use continued rising, but there was far more network capacity than the market needed at that moment. By 2004, long-haul bandwidth prices on major routes had fallen by more than 90%. More than 90%.
the technology became more useful every year. The companies selling access to the infrastructure were still forced to charge dramatically less because too much capacity was chasing the same demand. Growth alone was not enough. The growth had to be faster than the supply created in anticipation of it. Telecom companies failed. Shareholders were wiped out. Lenders took losses. But the fiber did not disappear. It stayed underground. Years later, streaming video, smartphones, and cloud computing needed it. New companies benefited from infrastructure that earlier investors had paid too much to build. The internet changed the world. Many of the companies that financed its early infrastructure still lost money. Being correct about the technology was not the same as being correct about the investment.
There is an important difference between that period and today. The largest AI builders are much stronger than many telecom companies were. Amazon, Microsoft, Google, and Meta generate enormous profits. They have strong balance sheets and access to deep capital markets. The NASDAQ 100 also trades at roughly 27 times expected earnings, compared with around 60 times near the dot-com peak. So this is not a prediction that the year 2000 will repeat exactly. Markets do not copy and paste history. Strong companies can absorb mistakes for longer. They can fund construction without immediately depending on fragile outside investors. They can wait years for demand to develop. But that creates a different risk. Strong companies can also spend much more before discovering that too much capacity has been built. Financial strength reduces the chance of an immediate collapse. It does not make overcapacity impossible. Forget the daily movement of AI stocks. Watch 4 operating signals. First, utilization. Are the new data centers staying busy, or are companies struggling to fill them? Second, pricing. Are AI and cloud providers cutting prices because too much capacity is chasing the same customers? Third, depreciation. Are expensive chips aging faster than the revenue they produce? And fourth, financing. Are companies increasingly turning to debt and long-term leases because internal cash is no longer enough? One weak signal proves very little. A price reduction could simply mean the technology is becoming more efficient. A temporary drop in utilization could come from a new facility opening before customers move in. But several of these signals weakening together would be much harder to ignore. That would suggest construction had moved ahead of paying demand. So, is AI a bubble? We cannot honestly know yet. But the risk is now clearer. The risk is not that AI suddenly becomes useless. It is that companies build 5 years of capacity before customers are ready to pay for 5 years of capacity. Memory suppliers are already being paid. Data centers are already being built. Electricity is already being reserved. The hardware is already being installed. On June 25, part of that bill appeared on a MacBook price tag. That price increase does not prove the investment cycle will fail. It proves that the cost of the race is already moving through the economy before the final return has been established. AI may change the world. The internet did too. That never guaranteed that every company building the infrastructure would make money. The machines are already here. The revenue still has to catch them.